Hello, this video I want to introduce to you just at a high level the concepts of discount rate and cost of capital. If you think about what we've been doing in our present value calculations from time value of money stuff, we talk about this concept of an interest rate, which we call the discount rate. And we use that as a discount rate because in time value of money and present value, you discount, you basically reduce the value of the future cash flows back to their present value based on this interest rate. So if you remember from the time value conversations, that rate reflects kind of the following things. The first would be if you're somebody that's looking to invest money that you would then withdraw into the future, this is the rate of return that you would expect to get on the money that you invest today, so that it would grow, so that you would have enough to withdraw some into the future. And so in that sense, this interest rate is considered to be the rate of return or the return on the money that you've invested now. If you were, instead of investing money, if you're borrowing money now and you have to repay it in the future, then this interest rate is the amount that you're going to be charged each period for borrowing the money. And so in this context, we would think of it as the cost of the money, or maybe the cost of capital it's often referred to. And so the key thing that I want you guys to understand is that in terms of terminology, this term discount rate, the term that we use, either rate of return or return on investment, the term we use as cost of capital, they're all generally referring to the same interest rate. It's just a different perspective. Depends on if you're an investor or a borrower, or in the case of somebody that's just trying to value something, they're neither the investor or the borrower. The present value of it, and they're interested in getting the present value of it, then they would use this discount rate terminology. And so that's really the thing that I want to reinforce at this level, is that when we talk about the discount rates, the rate of return, the cost of capital, throughout this and the next modules, we're talking about the same concept. And so a lot of times students get lost because somebody doesn't connect the dot and say, oh, that term means the same thing. Don't think that we've introduced something differently. We just describe it differently in a different context, or use a different word for it in a different context, but it's really the same concept. So that's the main reason I wanted to hit on that. In terms of the determinants of this rate, whether it's a discount rate or a rate of return or a cost of capital, generally individuals think of three factors when they're negotiating discount rates. And we'll talk in a minute about what I mean by this negotiation. But the first of these is what we call the real interest rate. And so sometimes some people refer to that as the time value of money, or sort of the base value of money. And think of this as how much you as an investor would want to earn for giving up the use of your money for a future date. So it doesn't have to do with inflation, doesn't have to do with uncertainty or anything else. You're guaranteed to get the money in the future. And when you get it in the future, it will buy just as much as it will buy now. But the fact that you have to wait to be able to buy stuff and enjoy your money, you want some compensation for that. That's what we would call the real rate of interest. Closely related to that is the inflation rate. And so inflation is this notion that over time that things get more expensive. And so the reverse of that would be that a dollar a year from now won't be able to buy as much as a dollar today, because the prices of things have gone up. And so simply put, from a discount or interest rate perspective, at a minimum you would want to maintain your purchasing power. So if you were to loan somebody a dollar today, and today it could buy X amount of some good, you want to at least get a high enough return so that the amount that you get a year from now, let's say, will still be enough to buy that same amount of that good. And so you haven't lost any purchasing power. And so inflation is absolutely something that you think about. The last thing, and sort of the big thing, that we talk about a lot in evaluating projects and so forth is risk. And risk is basically the potential for loss as a result of some uncertainty. And the idea here is very simply that the greater the risk, and therefore the greater the potential for loss, or the greater the loss that you might have some potential of incurring, could be either of those. So you could either have the chance of losing something, and there's just a real big chance that you might lose some money, or there may be a very small chance of something bad happening, but if it happens, you're going to lose everything. Either of those are still examples of risk. And so when you as an investor perceive that putting your money in, that there's some risk that you won't get your money back, and you may not get the money, ideally you'd want to get the money plus your expected return, then you generally are not going to like the thing as well. You're not going to be willing to pay as much for it. And in fact, you'll continue to price down what you would be willing to pay for it until it gets to a point where it's so cheap that even taking the risk into consideration, you would still buy it. Well, by not being willing to pay as much for it, that raises the amount of return, or the rate of return that you would get on it. So think about it this way. Let's say that I've got something that in the future is going to pay me $100, but it's a risky $100. And initially somebody is saying, so how much will you give me today for that? And if it had no risk at all, and all you really cared about was inflation and so forth, you might say, I'd give you $95. So I'll give you $95 today, and in a year I'll get $100. But if it's a very risky bet that you'll actually get the $100 in the future, you might say, well, I don't want to give you $90 or $95. I only want to give you $75. Well, if you went and kind of calculated it on $95, you're gonna earn $5, and so if you just did $5 divided by $95 to get sort of a percentage, you would very quickly conclude that that's about 1/19, right? And so 5 divided by 95, it's going to give you little over 5%, about 5.2% return. And so saying that you would give $95 for $100 if there was no risk is the same as saying I would be happy with a 5.2% return. When you price it down from $95 to $75, now you're saying I'm going to make $25 off of a $75 investment, and so now you're talking about making a 33% return. So 25 divided by 75 is a third, or 33 and a third percent. So now you're talking about a 33% return. And so the fact that it is more risky has caused you to say you'll pay less for it in order to get that future cash flow. And by virtue of doing that, you have upped the return. And so we can infer from that a 33% return is enough to compensate you for both the real rate, the inflation rate, and the riskiness of this investment. Now, that's conceptually what individuals think about. But at the end of the day, it's important for you to understand that in most cases, a discount rate, an interest rate, a rate of return, all of those things are the result of a negotiation. And so on the one side, you have somebody who is going to put in the money, we'll call them the investor, and they always want to try and get the highest possible return on the money they invest that they possibly can. And they certainly, if they look at an investment and compare it to other similar investments, they would not invest in a project, let's just say, and accept a lower rate of return than they could get from other similar projects that they already know they can get a return on. So as an example, if as an investor I look and I say, I've got you asking me for $1,000 to invest in a project, and you're basically promising me as a rate of return a 10% rate of return, and then I've got two other projects over here that are both asking for $1,000, but they're willing to offer me 15% return. I'm going to take the 15% return. I'm not going to take yours. And that's basically the idea behind this from their perspective. They're going to understand that they just can't get whatever amount that they want. So they can't just say, no, I'm not gonna do it unless I can get a 40% return. If nobody's offering a 40% return, then I never get to invest my money. So they'll lower their expectations down to a level that they're comfortable with, provided that there's some alternative that will give them enough return. And so, by the same token, you can't force them to take a 10% return if everybody else that has similar type projects and similar type risks is offering 15%. Now, on the other side of that is the project developer. That's you guys in a lot of cases. And you're seeking the lowest possible cost of capital. So instead of looking at it from a rate of return standpoint, you're thinking that, oh, I have to pay an interest rate to you to get the money. And so from your standpoint, you would like to have the lowest cost to get the funds for your project that you possibly can get. And if you have an investor that's saying, well, I'm only going to give you the money in return for 15% return, which would be a 15% cost to you, you might look at other sources of funding, and if somebody else comes to you and says, well, I'll give you the money for 12%, you'll take it from them. And so that's kind of where this negotiation sits. You got investors who will push you to try and give them a higher rate of return, and if you don't respond and at least give them something comparable to what they can get someplace else, you may not get the money. And then you as a developer want to try and negotiate for the lower cost of capital. And from an investor standpoint, if they keep saying, well, I want 15%, you may go look to other investors and might find one that's lower, in which case your investor's left basically not being able to invest their money and they don't get any return on it. And so that dynamic is what creates the back and forth between the two, where the investor runs the risk of not being able to find a home for their investment at all, and the developer runs the risk of not being able to find the money to fund their project. And so they both have an incentive to try and find some sort of a happy balance in between, but they also both have their limits where there's no reason for them to accept a deal when it is inferior to other alternatives that they have. And so it's very important that we understand that because of that, both sides are sort of competing against the rest of the market. Investors that want returns are competing against other investors to find a home for their money. Project developers who want lower cost of capital are competing against other projects that may be willing to offer higher rates of return to the investors, and so pay higher costs of capital in order to get that. Anyway, that's kind of the very, very high level dynamic of this. From here, we're just going to talk about how that negotiation might unfold for two popular funding sources, debt and equity. So hopefully this overview kind of gets you in the right mindset. Thanks.